Good day traders, Stacey Burke from Stacey Burke Trading, and today we're going to be going over breakouts and pullbacks with the end of day trading. And again, if you've looked at some of the other modules on opening range, trend lines, support and resistance, just again another tool to put in your toolbox with breakouts and pullbacks. I'm going to show you some really simple strategies to start looking at where the market may be struggling and where you may find an opportunity to enter the market with a fairly low risk to higher reward in terms of entering the market. So just looking at the New Zealand dollar here, again, I'm going to go through a few different pairs, but just randomly picking, I have no particular reason. We're just going to start off again, just rehashing the dotted lines are the beginning of the month. And as we've talked about in other videos, I'll often look at the opening range for opportunities to enter the market with a fairly low risk, high reward. And what I mean by that is that's an opportunity, good time to enter the market, possibly where with your monthly average true range, you have the opportunity, if the market is going to move strongly, to position yourself possibly with a 1R risk or 1 ATR risk, and for possibly 3, 4, 5 or more maybe ATR returns. So something to consider. Just apply these, back test them yourself. What we're going to look at today is breakouts and pullbacks, and for the purposes of this video I'm going to define a breakout as a candle that completely closes outside of the range of a previous day. So the close is out of range or out of balance in relation to the previous day. So we're not looking for successive candles, we're looking for that first candle. So in this particular case, you can see that this bull candle is closed above the inside bar bear candle. We'll just start here for reference. Obviously there's a breakout to the left of that as well. There was a breakout here of a bear candle. What's significant about this is that you're going to try and look for opportunities where the market is either going to maybe fill a gap, or possibly where you're buying low or selling high. So in this particular case, if we were to enter this market thinking that the market was going to go upwards, we would want to position ourselves somewhere down in this lower part of the range so we could buy low. Our stop would be placed below that candle. The market breaks, is already broken out, so it's showing us some degree of momentum, and this market could potentially head down. So what we want to do is limit our downside, and our downside would be, maximum would be here, so we position a limit order up above here so that if the market picks us up and moves north, our risk is limited, but we've got at least 2 to 1 heading back towards where we know there's other stops. The market did indeed trade through that. Then it started to slow down. We have an inside bar, roughly a sort of an inside bar, the first day of the month, and then again a bear candle that breaks out of range. Now, when we go into this next month, the market breaks out, and again at this point we're looking at a market that potentially is making higher highs and higher lows. So the wick on this candle is a good signal for traders to be looking at, knowing that the market may still test that lower part of the range, but there's evidence of two-sided trading if we look to the left with the big bull candle. Now, as the market auctions lower, now we've got two-sided trading. We've got evidence by the bull candles. If we were to try and position ourselves again, either buying low and looking for a return back into that trend, we would be wanting to look at possibly positioning ourselves above here. And again, this is an inside bar. So again, another little signal from the market. So up until this point, I wouldn't be buying a break above that bull candle. And the reason why is, we'll just clear this. We'll look at this again. So if we have a breakout, this bull candle has pulled back, but it has stayed below the breakout of the low of that bear candle. and that's a critical point. So we want to make sure that if we see bullish activity that we're going to position ourselves in, we want to know that if it breaks the high of that candle, it's going to go where we have bear stops placed. In this particular case, the market has stayed below, so it's bought up, but it's been sold down and stayed below that original breakout, and that's critical. We know that if it breaks the high up here, that it's already gone by where this previously failed, but we've got bear stops above that candle now. And again, that's a more aggressive entry. If traders want to be more conservative, they could certainly wait until the break of this candle, which would certainly put us back moving in the direction towards those highs. So traders who got in early, of course, they've been able to position themselves. They may have looked to take profit somewhere up here. They may move their stop to break even, in which case they run the risk of getting stopped out at break even, or they may just sit again on that original entry with their stop intact down below here. The market made two legs back up, took out the highs, and then again auctioned back down inside. So just to reiterate, all we're looking at is peaks and troughs and breakouts and pullbacks. So we want to know if a breakout fails, so we got a breakout here and then a pullback, there's a position, an opportunity where traders could position themselves with a stop below that range. And again, we've got a breakout now where the market, if it breaks through that level, will be past 50% of that previous range, and chances are it's going to run back to want to test orders that are below the original leg up. So again, the market breaks out here. Aggressive traders, if they were trying to trade the range, may not have been picked up. The market pulled back, and again, now we've got an opportunity where we know there's bear stops, and the market, if it trades through there, is going to pick that up and should move quickly back up towards old highs. Now, as evidenced here, again, we're at a critical time frame at the beginning of the month. The market has a high probability that when it reaches that first couple days of the month, that in a large majority of the cases, one of those two candles, highs or lows, may act as a selling or buying extreme for the month or for the first half of the month. So in the previous month, we saw that the high was established here for the range. The market broke out. It immediately auctioned down, but it struggled to go any lower and then reversed back up. So now we've got the potential of what they call a range-bound market. And if you're not sure, if you don't understand that completely, check out Dalton's book, Market Profile. So a market that trades back through the open may now be going into a range-bound market, which we saw, and then the market proceeded to go sideways for the rest of the month and a little bit back up. But a market that auctions strongly off the beginning and moves in one direction has a probability of possibly being a trending at least for half the month or maybe the full month, and that's where you may be looking at, if you've positioned yourself 1 hour risk and the range for the New Zealand was maybe 400 to 500 pips, so you've got maybe a 4 or 5 to 1 return on that 1 hour risk. So yeah, you're just looking at your breakouts and pullbacks. You're looking at the time frame at the beginning of the month to position yourself possibly in the line. So in this particular case, we got very strong momentum on the second day. Traders that wanted to get aggressive could place a on-stop order here, limit order with their stop above that candle. And as that market proceeded to auction down lower, they may look at moving their stop depending on how their trading strategy is to manage that. So just looking at this in terms of breakout pullback, market breaks out, has an inside bar. It's a pullback. So again, that could be traded on a breakout with a 1 hour risk. The market breaks down, then we have a pullback. Now, as we enter into this, the market may have a two-legged pullback. So again, traders that have either entered in short up top with a stop below above that candle, or they've entered in on the break of that candle, they've placed their stops up here. Should have been okay on that second drive down. So the market breaks out again, pulls back. So traders who are trading the break, again, there's your 1 bar stop. Again, market. Now here's an example of where the breakout fails. Now this is critical. So if you were to trade the break of the bear candle, remember timing is key. We're at the end of the month. We've had 3 drives down. As soon as that last candle of the month takes out that high, traders could be looking to position themselves on a break of that high back towards these old stops up through here. The reason why that is that once that trade fails, we've got a high probability of it auctioning to the other side at a minimum of where those other stop orders are, because that's where the liquidity is. So you've just got to be patient, to be willing to go bar by bar, go through the charts, start looking for these time frames at the beginning of the month. The market changes. I've talked about this in other videos. We get institutions, banks, a lot of the large trading funds, they lock in profits. We've got a new economic calendar that comes out. We've got options expiries. We've got futures contracts expiries. So there's lots of things that all happen that can cause the market to change. And the beginning of the month is a really key time to be looking at these opportunities to position yourself potentially in the line of a strong move, but at least a low risk for greater reward trades. So hopefully this helps traders. Breakouts and pullbacks. Start to identify where the momentum is. Look for two-sided trading. Look at the beginning of the months, the opening range. Stay disciplined, manage the downside, and may the markets go with you. Thanks, traders. Hi, traders. It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.